We'd like to welcome you guys to the 2022 year-end update. What we like to refer to as our favorite time of the year. I'm not sure if Jillian or Kate will agree with me on that, but we'll go with it's our favorite time of the year. As we're going to be going through this with you guys today, we have the presenters that, Kate Senso is Outsourced Payroll Senior Manager. She's going to be helping out with the W-2, anything regarding payroll year end, and then myself. And then Jillian Robinson is going to be talking about anything to do with 1099s and getting ready for the forms that need to be filed coming into January. The agenda today is we're going to go over is how do we plan for a successful year end. The year end compliance, we're going to go through the W-2s, 1099 forms themselves. And then how do we start the year off right? Because a lot of times we have to be coming in with doing our year end and the first of the year payrolls and 1099 reporting at the same time. We have a lot of information packed into this hour, so we will try as hard as we can to get to some of your guys' questions. If we do not get to them during this presentation, please follow back up with an email to us. Our email addresses are on that front slide where it showed the presenters, so you guys can reach out to us with those emails. All right, so coming into planning for our year end, from the payroll side of things, Jillian will talk about the 1099. But really, when we start payroll for January of 2022, you are already starting to prepare for your year end. So the first payroll of the year, we're paying out the first wages, withholding the first set of taxes, and making those and remitting those taxes to either the federal or the state. As we go through the entire year, there's things that we put in place to make sure that we are reconciling, we are tying out, making sure that our wages are between both gross and taxable, and our payments are tying out towards our quarterly returns. And at the end of the year, when we hit that W-3 stage, we can put a bow on top of it, is what we always like to say, that our W-3 form actually ties out to all of our 941s. If you're a 943 filer, your state returns, because both the federal and the state will be looking at what we remit with that W-3 to make sure that our wages match what the returns do, and the withholding tax also matches what the returns do. So we want to make sure that as you're going through here, this 5 steps of payroll, that you're watching that on a per payroll, per quarter basis as you come into year end. The things that we need to also be, talking with our employees is the need to review their information. It is so important for you guys to be having these conversations. If you have any type of a software that can blast out messages, remind them to be looking at their paychecks. What is their full legal name on that pay stub? The IRS came in and the SSA came in pretty hard with no match letters. And what that means is that the Social Security card did not match the W-2. We had some people getting, that you had like 76 of your employees did not tie out or match out to the name that the Social Security office has. That's kind of a scary letter to get. But really, it's just making sure that you're looking at that. If you have an employee who changes their name, regardless of the same marriage, then they can't just turn in a marriage certificate for something like that. They have to go into the Social Security office and actually change it on their Social Security card. So very important to make sure that whatever you put in the system matches that Social Security card. Make sure they get their current address in. Some people ask us if we can do W-2Cs because they say the W-2 got lost or it's got the wrong address. And I'll tell you, you cannot do a W-2C for an address change. So make sure that you're just getting that information from the employee so that it's current before those W-2s are being mailed out. Remind them to look at their Social Security numbers. Sometimes they are, masked so you can't see them. But if you have an online software that you can have the employees go into and review their information, then they can go out there, because sometimes it's hard when you get an employee that maybe for the first time they looked at their W-2 and they're like, wait, these numbers are actually, typoed, or they're flipped around. Because not only are we having to do a W-2C to fix that, but you're also having to go into any state unemployment return and also adjust and amend those returns also. So it's just a good reminder to have the employees be looking at that information. And one of the bigger ones too is the state income tax. We've had a lot of people who have been moved to a remote status. And so they may have, previously during COVID, were able to stay in the state where they normally had withholdings. But now if they're actually in a different state, living, working in that state, then that W-2 should be reflecting the state that they are currently working in. So if you're going to have to try and make an adjustment to any type of state income tax reporting, it's going to be easier done during this current year than it is going to be coming back and amending. So make sure they're watching that information so that it is up to date.
All right, let's start with the basic, like with gross income. What is gross income? It's all income from whatever source unless excluded by law. So we're talking about all income you earn before taxes and deductions. And some examples of that is cash, property, services, meals, accommodations, and stock. The thing you have to remember though, that gross income does not necessarily mean it equals taxable wages that would be reported on your W-2. Your taxable wages is your gross minus pre-tax deductions. So if you have an employee that may come to you, come January, they get their W-2, they're also trying to compare it to their year-end pay statement. Those numbers may not match because what's reported on your pay statement may be your gross income, or your W-2 has your actual taxable wages on there. Taxable fringe benefits, what is it? It's a form of pay other than your employee's normal rate that is considered compensation. It's really important that you start planning ahead for taxable fringe benefits. You can even start like the first payroll of the year and make sure you have communication with other departments within your company. Looking at your AP department, did they record something like gift cards that were paid out to employees that we need to put on as taxable wages to your employees? We need to know who got it and then the dollar amount. Because if these things are not recorded accurately and put on the W-2s in time, it could result in an IRS notice, late filing, penalties for late payments, which we all do not want to have to take care of with that. So with taxable fringe benefits, there's a few major things that you want to consider here. The first thing being the fair market value, because this is how you're going to determine that amount that's going to be taxable to the individual. So the fair market value of the item is less any amount the employee paid with after-tax dollars, less anything that could be excluded by law. In order for it to be non-taxable is what we call a de minimis fringe benefit. And this is for a property or service where the value of it is so small that accounting for it is kind of unreasonable or impractical to do. There really isn't a dollar limit. A lot of companies like to try and say, anything under $75 we're going to do is non-taxable, but the IRS hasn't assigned a dollar limit to this. Some examples of a de minimis fringe benefit would be like your occasional sports tickets that you give to employees, or occasional happy hour that your office hosts in the afternoon for employees. Kind of the key term there is the occasional. It's not happening, often, and it's not the same individual receiving the benefit. When are fringe benefits considered paid? You can elect when you pay them. You can do it per pay period, monthly, quarterly, but you have to at least do it annually. And then they are subject to the deposit rules that you would follow. With the special accounting rule, you see this mostly, it's common in personal use of a company vehicle. This is to help with accounting for these taxable fringe benefits. You can elect to treat the value of non-cash benefits provided in November, December as paid in the next year. If you do use this as a special accounting rule, you must treat all employees that receive the benefit the exact same way. Depositing the taxes on the fringe benefits, it does follow the deposit as the rest of your payroll. So if you're a semi-weekly depositor, you're going to follow that exact same rules for these fringe benefits. Or if you're a monthly, you would follow that and have them due the 15th of the following month. So how do you determine what your actual deposit schedule is? This is for 941 filers. The look back period is July 1st through June 30th. So it's a 4-quarter consecutive period. You'd be considered semi-weekly if your liability for that July 1st through June 30th is $50,000 or more. So if your check is dated Saturday through Tuesday, your tax payment would be due on Friday. If your checks are dated Wednesday through Friday, it's due the following Wednesday. For monthly, if you're under that $50,000 liability, your payment is due the following month on the 15th. If your liability is under $2,500, you're considered quarterly and you're able to pay with your 941 return. But then of course the IRS does throw in additional rules. It's the $100,000 rule. If your liability does go over $100,000, it is due the next business day. Once you do hit this this $100,000 rule, you do remain semi-weekly for the remainder of the year. It is really important that you watch this time of year. I know a lot of companies are paying out bonuses and some of them can be bigger that it potentially puts you over that $100,000 rule. So it's really important that you really watch that and make sure that you make them timely and that you hit the next day if needed.
So some employees are, able to receive loans from their employers if it's something that your company is willing to provide to employees. When it becomes an issue in the payroll world is when this loan is forgiven And if the employer has determined that at this point that they are going to forgive this loan, then it would be added into taxable wages on the W-2. As you're coming into the end of the year, if this is something that they are going to forgive, just make sure that depending on the size of the loan, that they have enough income to be able to have taxes to be withheld from that loan that they've already received, because their net check is not going to have that much in it to cover if it's a substantial loan dollar amount. The other times that the loan would be included on a W-2 is if the interest rate is below the federal market rate. So if, like, let's say if they decide to be generous to an employee and they're just going to charge an interest rate of 2% and the federal interest rate is 6%, we will have to figure out the difference and put that on the W-2 as taxable. And that should be done on an annual basis if that interest rate is below. But really, once they hit that loan and they forgive it, then all of it becomes taxable at that time.
2% shareholders. This is very specific to S corporations. So any dollar amount paid by the employer for these 2% shareholders in regards to health insurance or health and savings accounts, HSAs, this is taxable income to the shareholder. It's not subject to Social Security or Medicare tax, and you do not have to withhold federal or state withholding on there. So for both of them, for health insurance and HSA, it gets added back on the W-2 in boxes 1 and 16 and a memo in box 14. The memo in box 14 is very important. There's only so many lines depending on how your software is set up that can go into box 14. It's very important that this is visible to the shareholder. So when they go to file their individual return, that their tax preparer can see that, because then they are able to get that above the line deduction. For group term life insurance, the dollar amount is 100% taxable on the whole amount. Unlike their other employees, they do not get that first $50,000 tax free. And just a reminder with S corporations and 2% shareholders, they are not able to participate in pre-tax benefits. They can have the benefit, but it needs to be done as an after-tax deduction. Third-party sick pay. Anybody that's in payroll knows how kind of what a pain this can be. It is a great benefit to your employees, but it can be kind of a nightmare on our end. The biggest questions is, how are the disability checks going to be taxed? Is between the employer and the third party, who's paying the taxes, who's going to be doing the W-2s? That's something that you have to work out when you set up the plan, and it's important to know that information. So for being taxed, if the employer paid the premiums, the employee will be taxed on those wages when they go out on leave. If the employee paid the taxes or paid the premiums with after-tax dollars, then when they go out on leave, those wages are non-taxable to them. Now with the reporting requirements, you got 941 reconciliations, tax payments, W-2 reporting, and then the 8922, the third-party sick pay recap form. And this is where you need to determine who's doing what. So if the third party is going to be responsible for remitting the taxes for the employee portion, then the employer is usually responsible for remitting the employer portion of the taxes. So the third party will be remitting or showing on their 941 the employee portion of the taxes, and then you as the employer will be showing your portion on your 941 return. And then if you as the employer is doing the W-2 reporting for the sick leave, then the third party will be doing the 8922 third party sick pay recap form. And the sick pay recap form helps balance out the year from what was paid, from what the third party paid and what the you as the employer paid.
So the taxable fringe benefits regarding awards and prizes. And so we're going to kind of go over like what's taxable and what's not taxable in the regards of the awards and prizes. And, this is a topic that gets real creative, because as employers, you really want to be giving your employee a gift. You want to, tell them thank you for what they've done. And then according to the IRS, you got to come in then and tax them and report that on their W-2. So just so you guys know, anytime that an employer gives an employee gift cards, that is 100% taxable always on the employee's W-2, as well as anytime of like a company picnic or Christmas party and, someone won a TV or got airline tickets or, an iPad that, you can understand that, like we were talking about with the de minimis is that, who got it, we can determine the fair market value of it pretty easily by going online and looking to see what would it cost to buy this TV, at Target. So just so you guys know that those, even though you're trying to be a very, generous to your employees, those items are taxable to them. As we go through these different slides, we can show you how, as the employer, you could gross it up and pay the taxes for the individual, but there's a cost to that also. So we'll kind of go through that with you guys, but from a non-taxable perspective, there's two awards and prizes that are non-taxable. It's safety and length of service, but even that can, become taxable. So safety awards, less than 10% of your employees are eligible. You have to be full-time with 1 year of service. And then that you have to exclude out your managers, professionals, administration, and clerical are not eligible for this award. From a length of service, we reward tangible property. There is dollar values assigned to this though. So we have a W-2 ebook out in our year-end landing page for Eide Bailly, which will give you those addresses later on. But it can help you understand like what is those values that these tangible property would be. And then, this award has to be presented in a meaningful ceremony in every 5 years of employment. Now, if you give your employees a gift card for length of service, it becomes taxable. So it has to be tangible property.
All right, personal use of auto. So if you offer your employee a company-owned vehicle to drive, any personal miles driven by that individual is taxable income and W-2 reportable to the employee. Some examples of that would be like daily commuting, use of vehicle on the weekend, using it after work to run errands. This would all be considered personal and taxable wages to the individual. The business use is excluded from income. Employers may elect not to withhold federal income tax, but you at a minimum have to do Social Security and Medicare taxes. And the record keeping does fall on the employee. If the employee can't supply the information, if an audit would occur, it would become 100% taxable to the individual. And here we just want to throw out, we do have a specific book here in regards to personal use of auto. It is on our year-end landing page. We will go through some of this information kind of at a high level, but this book will definitely go into more detail and hopefully can answer any kind of questions that you may have in regards to personal use of a company vehicle. All right, there we go. Okay, so there are 3 methods that you can use. So the first method is commuting value method. This one allows employers to value an employee's personal commuting by either $1.50 per one-way commute or $3 for a round trip. But there are 4 conditions that have to be met. The first one is the vehicle is owned or leased by the employer. The employer, for non-compensatory business reasons, requires the employee to commute to and or from work in this vehicle. And the employer has a written policy prohibiting the employees from using the vehicle for personal reasons. And you have to make sure that the employee is not considered a controlled employee. The annual lease valuation method, this is probably the one that's most commonly used, mainly because there's not as specific requirements as the other 2 methods have. You're going to determine the fair market value of the vehicle. And every 5 years, it does have to be revalued. And you can use Kelley Blue Book to figure that dollar amount out. There in the publications, there is the IRS annual lease value table that you'll use in the calculation. But then you calculate the percentage of personal miles driven. And then after that, you calculate the value of the employee's personal use. And if you as the employer does pay for gas, you have to add on additional 5.5 cents for this. And this is where the we talked about the special accounting rule. This is where with the personal use of auto can come into play. For method 3 is the cents per mile evaluation method. Remember back in 2021, the mileage rate was 56 cents per mile. And then in 2022, we did have a change. So for January 1st through June 30th, it was at 58.5 cents. And then July 1st through the end of the year, it's at 62.5%. And it probably will be increasing, I'm guessing, in 2023 or maybe not. We'll have to kind of wait and see, but they usually do release that probably early November or early December timeframe. But just remember, if you are using the special accounting rule, that you're going to have to factor in 2020 rate for November, December of last year. And then January through June 30th, you're going to have a different rate. And then July 1st through the end of October, you're going to have the new at 62.5 cents per mile on that. But in order to use the cents per mile valuation method, there are conditions that do have to be met as well. The vehicle must be driven at least 10,000 miles annually. And the fair market value of the vehicle when first put into use cannot exceed the luxury car value, which for 2022 is $56,100.
All right, so group term life insurance. So this is something that a benefit to the employees as an employer. More and more have set this up to be on a per payroll basis instead of just putting it on at the end of the year like most taxable fringe benefits, and that's due to employees leaving. If your employees are leaving and you have to input this into their W-2, they do not have a paycheck to pay in the taxes on this. So if you were to only do it once a year, let's say best practices would be say at least do it quarterly, if not every single payroll. So group term life insurance is taxable if you offer a policy that is over $50,000. So anything above that $50,000 would be part of that calculation and be taxed on the employee's W-2. To do the calculation, you do need the employee's age, and it would be what is their age as of 12/31/2022. 2% shareholders, you do not get to have that $50,000 exclusion for this. So it is at the 100% value of what the premium is for that year would be inputted into their W-2 as income for box 1, 3, 5, 16 if you have state. Dependent group term life is that if you are over $2,000, it is taxable, and it is anything that's the entire value of it would be. So if it's $3,000 that you offer, it'd be $3,000. Something to know about dependent group term is that it can be based on the age of your dependent. So if it is a child, you may want to use the child's age because they're going to have a lower rate. If your spouse is younger than you may want to use their rate because they're going to be able to claim that lower rate also. However, if your spouse is older than you, use your birth date because it's going to be the lesser dollar value also. On a non-taxable event, the beneficiary of the policy would be if that the employee's family is not inheriting this group term life, the company is. So therefore, it is not taxable to the employee because they are not receiving it. If the beneficiary is a charitable organization or a turned employee due to permanent disability. If the policy for the company is actually not even 50,000, it's less than that, then that is not taxable either. And then if your dependent care group term life is always said to be less than 2,000, it will not be taxable to your employees. Group term life is subject to federal, FICA, and state. However, it is exempt from FUTA tax, so your federal unemployment. Group term life would be reported on your W-2 in box 12, code C. And within like all the taxable fringe benefits we're talking about, we want to cover the supplemental tax rate. I did have a question earlier, like, well, what if we put it on the regular paycheck and then, would we have to use supplemental tax rate? And you don't have to. If you're putting it on the actual employee's paycheck, you can do the aggregate method, which is the W-4. Just remember your W-4 does span over, the pay period. So if it's a large amount, it's going to take that one pay period and try and annualize it, which could increase that federal and state withholding. So the federal rate is 22%, 37% over $1 million. Every state has their own state tax rate. So some of the things for supplemental tax rate is if you're doing bonuses, commissions, severance payout, the awards and prizes, the PTO payout, any type of back pay would be where you can apply the supplemental tax rate to that. As we're looking at doing some calculations, remind yourself that as you look at these taxable fringe benefits, most likely the employee already received this. As like a gift card, you gave them a gift card, they already got the $100 gift card. A person use of auto, there is no money exchange, the benefit was the vehicle. So as you're looking at putting this into their W-2, you have two methods to do this, what we call gross up and gross down. So gross up means the employer pays the taxes. You can see the calculation on the blue column where the net amount is the gift card. Now remember, you have to have your software set up, in a way that they don't actually get this paid out to them because they already received it. So either some softwares have what's called an in-out, it puts it on for tax purposes, or you have to create an earning code and then an offset deduction so that it does not go in their net paycheck. So you can see on the net gift card, we grossed it up. The actual value of that gift card is $142.15. And then if you have the employee pay their own taxes on this, just remember, you have to put this on a paycheck. So they have to be able to have net funds to be able to pay for those taxes. So if you put in that gift card of $100 up in the gross, you tax it down, the employee did get $100, but now they just paid that tax. So then their gift card value really was only $92.35 for this example.
All right, deceased employees. Hopefully you don't have to deal with this in your payroll career, but if you ever do, there are special ways that you handle depending on when that payment was issued. So if the payment was to the employee after death, but in the same year that the employee passed away, you do have to do withholding on the payment for Social Security and Medicare taxes. It is reported on the W-2 only in boxes 3, 4, 5, and 6. You do not want to show that in box 1. If the payment to the employee is after the year of death, you don't report anything on the W-2 and you don't do any withholding of Social Security or Medicare taxes on that payment. You do have to issue a form 1099 miscellaneous and put the dollar amount in box 3 for payments made in year of death or year after death and the payments made to the state or the beneficiary. For household employers, there are kind of special rules for this specific type of entity. Examples of household employers would be like your nannies, your housekeepers, your cooks, your butlers. It's also kind of known as the nanny tax. The dollar limit though for 2022 is $2,400 and it is increasing for next year to $2,600. So anything above this dollar amount, all the wages are subject to normal Social Security and Medicare taxes. But if you are a household employer and you pay anything under this dollar amount, you do not need to withhold Social Security or Medicare tax on those. You do still have a W-2 reporting requirement. It would still go in boxes 1 and 16 of the wages that you paid, but you don't have to actually withhold any FICA or Medicare tax. It is on a per individual basis, not what you're considered to be your whole entire payroll for the year. As far as the federal tax requirements for filing, no federal for 941, 944, 940. You do not make any EFTPS tax payments. All wages and taxes are paid on your individual return with a Schedule H on there. And also you are not required to withhold federal income tax. You only have to if the employee requests it and you agree with it, but the employee does need to provide a W-4 form for that.
All right, we're coming into the last part of our CARES Act for reporting requirements for our 941s, and the employer payroll tax deferral is the second part of it is due on December 31st. Just a reminder that if you did participate in the deferral, that you will have to do the last remaining amount in December 31st. I am hearing that the IRS is sending out notices letting you know what's paid. Some people are saying it's less than what they thought it should be. And just know that if there was any type of credits that you guys applied to, they may have actually applied some of that towards that deferral. So just kind of watch for that or request the information from the IRS, but that is due. And then as you are going to make that last payment, the EFTPS website actually did put out here a deferred Social Security tax type selection. So make sure you're applying that tax payment there so that the IRS can see that you did pay it back on time and that they can document that. Also within our forms, the 941, which was ever changing last year, we only had 2 changes in 2022, and we're happy to say we've been staying at the same returns on second quarter. So you would see that anything quarter 1 was a revised date of March, and quarter 2 through 4 so far is a revised date of June. So just make sure that you're using the right form as you, if you have to go back and do anything from quarter 1 that was missed, use the right form for that. Other thing too that we didn't have on the slide here is that we just got all the updated information is for the form 940. 4 states are part of the credit reduction that they did not pay back the federal loan that they borrowed in November. And those states are going to be, I've got my list here, hold on. California, Connecticut, Illinois, and New York. So what this means is that on your 940 that you will be checking the box for the multi-state. You will be going to Schedule A. On the Schedule A, you will look for the state if you have California wages. It is not all of your wages unless your whole entire company works in California. But it would be the amount of wages earned in California that you're reporting would be reported on that Schedule A. And this means that your tax rate went from a 0.6% to 0.9%. So every year that that state defaults on this federal loan, it will increase another 0.3 every single year until it is paid off. So just so you guys know, 4 states have been identified that did not pay back that federal loan, and that's California, Connecticut, Illinois, and New York.
All right, so we are going to switch gears here and we're going to talk a little bit about 1099s and independent contractors and how those are kind of different than W-2s and other things to watch out for at year end. So we just wanted to highlight, it's super important that you have the appropriate classification from employee or independent contractor. Employee, obviously all those rules we just talked about apply, and independent contractor, very few of those rules apply. Or at least the rules are way less. So if you do withholding for your employees, that's required, and those are W-2s. An independent contractor only requires the backup withholding if you don't have an appropriate TIN number. Social Security and Medicare are required to be withheld and paid partially by the employer as well. Where on an independent contractor situation, there is no Social Security and Medicare. That's all paid by the independent contractor. Many of the employment-related statutes apply as well. The Department of Labor enforces overtime rules, and we've got minimum wage rules and certain other requirements that are required for employee situations that are not required for independent contractor situations. So if you get caught coding a person incorrectly, just know that the IRS, if they do find you and come after you, you could have all this withholding that should have been done due and payable by you as the employer that miscoded. And then any states that apply as well. If you had a retirement plan that person wasn't eligible for because you miscoded them, you may owe that also. So it's a very expensive mistake. And the IRS has a pretty good detail on their website about what rules apply to independent contractors or how to classify independent contractors versus employee. So if you think you're in that situation, go take a look at those. And it's a good idea to make a memo if you're a little concerned, so that you know exactly why you coded that person an independent contractor if you get audited. A little blurb on the side here talks about how the IRS has been sending auditors out since 2010, looking for these type of misclassified employees and then reclassifying them and sending a bill to employers that are doing this incorrectly. So it could be very expensive. Just wanted to highlight that. Obviously, you probably already made your determination through the year, but it's a good idea to correct it as soon as you can, just to prevent further issues and penalties. Another thing that we need to do is watch out for the W-9 when you're paying someone as an independent contractor, and just make sure that it's filled out correctly. Some key things you need to look for is that the business name is on line 1, and that name agrees to the type of identification number they gave you. So if it's a name, it should be a social. If it's a business, it should be an EIN. You also want to verify that they check the box in line 3. And if they check the limited liability one, you want to make sure that they put in a C, S, or P, so you know whether or not certain forms and boxes apply or do not apply to them. When you first get the W-9, it's really easy to ask for an update or a correction. Like if you can't read it when you first get it or you're unsure of the number, it's a very easy, like, oh, I just got your W-9. Can you please update this for me, versus trying to do it in January when you're slammed for time and have other W-9s you're trying to find information on too. So I would just review it immediately and call them back right away. Another thing is just see if they signed it. If you get audited or something by the IRS and you have an unsigned form, you don't have a very good leg to stand on as far as doing all the appropriate work to get the correct number. Some best practices real quick on the W-9 is request one right away before you pay that first payment. Because once you pay that first payment, if you never see them again, it's going to be really difficult to get that W-9 filled out. You can also send an annual letter just to make sure nothing changes in case they've changed their address or they were a Schedule C and all of a sudden they incorporated. You wouldn't have that information unless you requested an additional W-9, unless they told you, and then you would get another W-9 for their updated information. You can use a TIN verification program as well. So once you get that W-9, if you can't read it or you just want to double check the information, run it through a TIN verification and make sure that it matches. And then if it doesn't, you can follow up right away to get the correct information. And then you can also use corporations more often, just because that reduces the need for 1099s in most cases. Some of the forms don't require them to be sent to corporations. And you can also pay vendors with credit cards or other third-party payment systems such as a PayPal, Square, any of those that are credit card processors. The credit card processors themselves will issue the 1099-K. So your 1099 miscellaneous or NEC, for example, are not required because they will be receiving a 1099-K on that information. A little bit on TIN verification. There are some like third-party processors that do TIN matching pretty well. If you go through the IRS website, which is what I've shown here, it is a little difficult to get your application going. You have to do this ID me login information, and it's just kind of a process. And it's somewhat difficult to share amongst your like employees if you have more than one person in the AP department. So if you want a TIN match, you could attempt through the IRS, or there's a lot of TIN matching websites out there, but they do charge money. E-filing updates. I had a few things not on the slide I wanted to touch on here as well. So the first thing to do for e-filing is if you realize you're going to have to e-file in January, you probably want to get a TCC code as soon as you can from the IRS FIRE website, which is fire.irs.gov, and then review that publication 1220 so you know how to e-file. Generally, the FIRE website is very, it's not super user-friendly. You have to upload a text file in the exact format needed. So usually you have to use a different software to get that formatted document in order to upload it to the FIRE system. So you can decide if you want to go through that process, or you just use a third party to file. Like for example, QuickBooks will allow you to file through QuickBooks. They charge money for that, but at least you don't have to try to figure out a separate software that will use that appropriate FIRE system upload. And if you do it through like a software such as QuickBooks, you do not need to get your own TCC code or TCC because they'll file it under theirs. Also, I've been hearing rumors that they will be reducing the e-file amount. It's $250 currently, so if you have any type of return, 1099 NEC, miscellaneous, interest, dividends, etc., each one of those, if you get over $250, you have to e-file your returns. They were talking about reducing it to 100 for 22 forms and 10 for 23 forms, but that has not happened yet. So as of this training, it is still 250 forms. The other thing that is not on the slide that I wanted to add is that I heard there's a new 1099 portal slated to launch January 9th. And I don't know if you guys are aware of anything IRS related slated to launch the 9th, but I would not hold my breath. Basically, this is called the IRIS system. So it's Information Return Intake System. And what it's supposed to do is allow you to download a 1099 CSV export. So you can fill that out and then upload it instead of using that awkward notepad file. It does say you're going to need a TCC code, and that code will be different than the FIRE system code. So if you think you want to attempt to use this IRIS system, I'd apply for my TCC code. It says you can begin applying by December 5th. So I would apply for that and see how it works and if you can use it. If you run into issues and you need help with your 1099s, reach out to us and we can help you file those. But that's the new IRS system. So I'm imagining by next year being 23 forms filed in 24, this site will hopefully be a lot better because the first year will probably have different bugs and things. You can use your FIRE system for 22 forms due in 23 as well. And I did go to the IRS website this morning and it is not available. So anyways, like I said, don't hold your breath, but that could be interesting and make things a lot easier for people who need to e-file, but don't want to pay a third-party software for that. All right, so a little bit on year-end compliance. We're just going to breeze through some 1099 forms here. So 1099 forms are prepared by a payer, the person who's paying the other person, taking the deduction on their tax return. If payments are made not in the course of business, so essentially personal payments, you do not need to file a 1099 for those. Payers themselves include entities such as nonprofits and governments that don't pay tax. So those entities are still required to prepare 1099s, but they don't generally receive 1099s. They're generally exempt from the receiving of those. But review the instruction for the forms you file. They all have different dates, it seems like, and different rules for each form and different amounts for different boxes on different forms. So it's always a good idea to review the instructions. And if you are unsure of if you need to file a form or not, it's always a good idea to create a reason for why you are or aren't filing the form and make a memo. So if you do get audited on that form, why you didn't file it or why you filed it the way you did, you have something to review in the future. Because who knows when the IRS will get around to the audit. And I don't know, I have a hard time remembering too much further back. So it'd be nice to have something you have as your reasoning to avoid negligence penalties. The Form W-9, you send that to request the information, which we talked about, and that's used in January when you're preparing your forms. So it's a good idea to get those forms all year long and make sure that they're up to date and appropriate. If you don't get the appropriate information on that W-9, you should start doing backup withholding. which is at 24%. And you want to do that right away because otherwise the backup withholding is going to be on you because you've already paid your vendor $1,000. It's going to be hard to get that back later. Just a quickie on who needs a form. Anybody that you paid, basically sole proprietors, partnerships, LLPs, and LLCs that file as partnerships. Corporations generally don't need one. LLCs depends on how they file their taxes. If they file as a corporation, they would not need one either. Tax exempt entities also mentioned do not require one. And also I said this earlier, if you have an issue and you're not sure, just research it and then make a memo as to why you made that decision. This is a little bit of the basics on the forms. $10 or more in royalties, $600 more in these items. And then the big change for 2022 is that 1099K used to be $20,000 and 200 transactions. Now it's just straight $600 or more. So a lot of people who maybe sold some stuff on eBay or had some sort of side gig, use PayPal or something, they will be getting 1099Ks most likely if they hit that $600 mark. Where previous years, it was kind of a lot to get there. This list is not all inclusive, and I think we're running short on time, so I'm going to breeze through some of these, but just so you guys have these slides, it's a bit of detail on the NEC, not a new form, so kind of basic information, $600 or more. If you have withholding, it is required no matter what. And the combined federal state was kind of a mess last year. So hopefully the IRS has fixed their system so that for the 1099 NECs, the combined federal state filing is good to go. It's hard to say until we hit January and start filing. This is just a snip of what it looks like. And in the miscellaneous, we have $10 or more in royalty, 600 and all these other items, and corporations are required for let's see, which one is it? Medical and healthcare, and then payments to attorney. So those are required whether they're a corporation or not. Just wanted to highlight that. Again, any amount paid if you do withholding, doesn't matter if it's below 600. This is just the form. And then I just want to draw attention again to the 1099K. So this did reduce, so it is $600 no matter what. And Venmo, PayPal, credit card reporting, some of those Venmo type accounts may not file a form. If you check like that personal, I feel like there's a way to do it personal versus business. Maybe not, I don't pay much with Venmo, but sometimes they won't issue a form. So that's when the 1099 would fall on you. Some of your vendors might get 2 1099s for that same income because you issued yours from your NEC miscellaneous payments. And then they also got one from the 1099K. They might call you back and ask you to correct their form to 0, which is not a big deal. You can correct that, but I would almost cover yourself a little better if you're not sure if Venmo is going to send one to make sure you're covered and the form doesn't get missed. These are just other forms to watch for, the basic forms we see most often. This is a quick summary of the penalties, and I won't read all these, but 6721 penalties, basically, if you don't file appropriate return and have the appropriate information on it from the IRS's perspective. The 6722 has more to do with if you didn't give the recipient the correct form by the appropriate date, or the information is wrong. And then they'll talk about W-2 penalties later, but these are all similar amounts, which we'll talk about. And I quickly talked about corrections. So it's best to make the correction as soon as you notice that a correction is needed. One, for the person receiving it, they can make sure their tax returns filed appropriately. 2, because the longer you wait, the higher the penalties get. So those are the main 2 reasons to go right away. And then there are 2 types of penalties, or 2 types of corrections that might be needed. Type 1 is 1 form only, type 2 is 2 forms. And then you need to determine if you need to e-file or paper those corrections in order to make the appropriate corrections and get the appropriate information gathered. Type 1 errors are when it's just like an amount, and you need to file 1 form. So I'm correcting an $1,000 to $12,000, and I just check corrected and update the form. I send it in and I move on. If I have made an incorrect amount, oh, sorry, my slide did advance. A type 2 form, I need to send 2 different returns. So that's when I've used the wrong TIN or the wrong name, and I need to correct the original information I filed to 0. And then I send a new original form, not corrected, for the actual information. And I would send both of those forms into the IRS and both those forms to the recipient.
Okay, so Form W-2 here. Payroll reconciliations, it's always so important that you do this every quarter, that you're tying stuff out, and when you get to second, third, fourth quarter, that you're tying year to date out in between all those quarters, so that you don't have any surprises at year end when you go to run your W-3 and all of a sudden you don't tie out. So here's kind of an example of reconciliation between your federal and state. Do remember that, we're showing taxable wages here, and that it shows that it matches your W-3. So you want your payroll reports pulling out of your software to equal your payroll returns, and then return that equal your W-3s. If that all ties out, like Andy said, you put your red bow on it, everything's good. And then you can avoid getting any notices either from the SSA or the IRS, which is always a good thing. Just kind of going a little further with those taxable wages. Remember, taxable wages does not mean gross wages, especially when you have pre-tax benefits. Like your pre-tax health will reduce all boxes on your W-2, where retirement plans only reduce boxes 1 and 16, your federal and state taxable wages.
As you're coming into looking over your W-2s for 2022, we want to make sure that you are aware of some of the limits that could end up getting your W-2s rejected. So as you're looking at your box 3, make sure that Social Security wages are never higher than the 147,000. And that would correlate also to box 4, making sure that the tax is the same. Box 10, dependent care, the max that you can put in there is 5,000. So if it ends up being 5,500, you have an issue that $500 needs to be added back to box 135 as taxable wages, because your max pre-tax is 5,000. Box 12, some of the things that you will notice in this is your 401k, Roth, your simple, and your health savings account. Make sure that your 401k or Roth has the right code, the D or the AA is for Roth. And then the 20,500, and if you are eligible for that catch up, that you can add that in there also. From a health savings account perspective, the code W, you need to make sure that you report that. You can have it listed either 1 or 2 times in that box 12 section, depending on how your software allocates the employee portion and the employer portion. It is very important that you do have to record the employer portion or code W. And then if your employee contributes on a pre-tax basis, that also has to be in the code W. Also for W-2 reporting for healthcare coverage, this has not changed for several years now. We'll be watching that 250. I'm curious if that's going to kind of go with the 250 down to 100 down to 10. But currently, if you have less than 250 W-2s from previous year, then you do not have to report box 12 code DD for the healthcare for the ACA. If you are over 250 though, just know you do have to report that employee and employer portion of health insurance in box 12 with the code DD.
Just a little bit there more on the penalty or on the due dates, so you're aware of the due dates required, and really just to highlight here on the NEC, the reminder that it's due electronically, paper, and to the recipient all on the 31st of January. Very minimal exceptions are allowed. Basically, a tornado has to have devastated your town, or somebody has died in order for you to get an extension on the NEC or the W-2. These other dates, I just wanted to highlight that you generally have an extra 30 days or so. If it's paper filing, it's the 28th of February. If you're electronically filing, it's the 31st of March. The recipient copies are generally always due the 31st of March. And before we go to the next slide, just a little bit highlight on that 250 or more per form is electronic acquiring and above, and that amount may change. But if you have 250 NEC, 250 miscellaneous, and 250 DIV, all of those are separate forms. So they would all have to be e-filed, or if you had 10 NECs and 250 miscellaneous, the NECs can be paper and the miscellaneous have to be e-filed. This is just another little snip of a different way to look at it. And a few extra forms are thrown in here that are less common, but there are some differences. For example, on the 1099B and S, those are due to the recipients on the 15th of February versus the 31st. Same with the miscellaneous. If you have reports in box 8, or that should be box 10 because I changed the form, those are also due February 15th. And then some other dates here, just kind of informational for you guys.
All right, for W-2s, the due dates to the employees and to the SSA is January 31st. And that third-party recap form for sick pay is due to the IRS on February 28th. For W-2s, if you have 250 or more, you are required to electronically file them. That's just like the 1099s, kind of watching that number for next year if it goes down to even a lower dollar amount. But do watch your states, because each state does have their own W-2 filing requirements. Some, it's all electronic, some you can still do paper, and they also may potentially have different due dates than what they are to the SSA. We just want to throw out the penalties on here. They do increase, it seems like every year. This goes for both 1099s and W-2s. You can receive them for failure to file timely or failure to file correct information. Do note though that if you intentionally disregard, there is no max, so it can be very costly to be late or file incorrectly.
All right, so kind of getting past the ending of the 2022, and we're having to kick off the January start of both our, 1099 reporting and our W-2 payroll reporting. We want to make sure that you guys are watching and advancing in your guys' software, the limits, and that you guys have the information for that. So for 2023, there was a significant jump for the Social Security wage base this year, 160,200 now for 2023. And then still remaining for the additional Medicare tax, the over $200,000, the employee does get an additional tax rate of 0.9%. So just sometimes your softwares are already set up to advance like this, but I'd say it's always good practice to be double checking that. From a retirement plan perspective, you'll see that the 2023 did also have an increase for all of the different retirement plans between 401k down to the simple, 22,500, 15,500 for simple, and then the catch up down below. And then the other thing just to make sure is that you really are making sure that your software is set up with the right code, the 401k being the D, the Roth being the AA, and the simple plan being the S.
All right, health savings accounts, they are increasing as well for 2023. There's the amounts on the screen, the difference between the self-only plan or family plan, and then you have your catch-up. Make sure your software is set up, that you can distinguish between the two different limits there, because that can really make a difference to making sure you're not over withholding. If they're only on a self plan, you don't do up to the family. And just remember that does get recorded on the W-2, box 12, code W, it's the employee pre-tax, and then whatever the employer puts in as well. Dependent care and flex spending account for 2022, it's 5,000, flex spending is 2,850. Dependent care in 2023 is staying the same, where flex is going up a little bit to 3,050.
Not much for 1099s. The IRS was obviously discussing reducing the amounts below 250 for e-filing, but we haven't seen that yet, although that might change based on this new IRS system. And then 24% is still the backup withholding rate for 2023, at least as of today when I looked it up. Starting in 2022, just a reminder, the transaction limit for 1099K is a 600, not the 20,200. And they talked about moving all the deadlines to January 31st for all forms, but that has not happened yet. It's kind of being discussed. So just watch for something on that, I suppose. And as I mentioned, just read the instructions and pay attention to the due dates. And then they're discussing a form for next year called the DA form, which would be for digital assets, which I don't have any more really details on that yet, but that's just something to kind of be aware of if that's something you hold or handle for your company.
And then also, so also we have our year-end landing page out at eidebailly.com/year-end. Out here is some really great information that is available to everybody. And there's the ebook for the W-2s, the ebooks for the 1099s that go into much more extensive details than what we were able to cover in 1 hour. Also out there is the person use of auto book and just some insights about trying to get ready for the year end. We also have separate landing pages for W-2 templates, 1099 templates, if we are providing any type of service for you that we actually produce the W-2s or 1099s. And if we don't, honestly, there's some great information out there too that kind of goes into more depth about the taxable fringe benefits, 1099 different forms that is available to you guys to be able to look at. Or even like I said, the ebooks are great. Download them, save them to your desktop. I wouldn't print them. Some of them are rather long. But it is something that could be of information for you guys. And like I said before too, like we were trying to catch as many questions as we were going through this. And If we missed one or if you guys weren't able to ask it, we do have our emails back on the very introduction slides that you guys can come out and ask that. And then if there's any other questions that, we got about 3 minutes left before the end. But if there's any other questions, please send them through. Otherwise, we do appreciate you guys coming to it. It's a lot of information. I know it's kind of a lot for 1 hour. So we'll keep working on, getting you guys the best information as we can. Let us know, and we thank you all for attending.